Dear friends, welcome back. In the previous problem, we have seen the concept of risk in a portfolio context. Now, what happens to the risk when you choose to mitigate it through diversification? And in here, I'm going to solve a problem that deals with risk in a portfolio context. So let's look at this problem. The stock of Box Limited performs well relative to other stocks during recessionary periods. The stock of Cox Limited, on the other hand, does well during growth periods. Both the stocks are currently selling for rupees 100 per share. You assess the rupee return, dividend plus price of these stocks for the next year as follows. So you have four economic conditions: high growth, low growth, stagnation, recession. And the probability is also given: 0.3, 0.4, 0.2, 0.1. And if you add all these individual probabilities, it will be equal to 1. Remember, the sum of all individual probabilities have to be equal to 1. And then the return on box stock is given: 100, 110, 120, 140. And the return on Cox stock is also given: 150, 130, 90, and 60. Now, we're supposed to calculate the expected return and standard deviation of investing: A, 1000 rupees in the equity stock of Box Limited; B, 1000 in the equity stock of Cox Limited; and C, rupees 500 each in the equity stock of Box Limited and Cox Limited. So, in the first two instances, A and B, this is nothing but in investing in individual securities. You either invest in Box or Cox. But here, once you put your money in more than one stock, then it becomes a portfolio. Okay, so here we're going to buy 500. We're going to invest 500 each in the equity stock of Box Limited as well as Cox Limited. Now let us solve this problem. Now, solution. Let's solve A first. 10 equity shares of B Limited can be bought for rupees 1000. Why? Because you have 1000 with you and the price per share is 100 rupees. So how many equity shares can you buy? Yes, you have, obviously, you can only buy 10 equity shares. Now, show the economic condition. All right, we're going to show the probability distribution, the overall return and probability. All right, so you have high growth, you have low growth, you have stagnation, and then you have recession. All right, so you have economic condition, overall return, probability, and then now show the overall return. Now this is for B Limited. We have to find out the expected return and standard deviation for B Limited. So you can buy 10 shares, right? So 10 times 100 is equal to 1000 rupees. 10 into 110, 1100. 10 into 120 is equal to 1200. 10 into 140 is equal to 1400. And you have the probabilities: 0.3, 0.4, 0.2, 0.1. Now let's find out the expected return. So the expected return is 0.3 into 1000 plus 0.4 into 1100 plus 0.2 into 1200 plus 0.1 into 1400. So let's calculate. So 0.3 into 1000, that equals to 300. So 0.4, that will be 440. That will be 240 and 140. So let's add this. So 300 plus 440 plus 220 plus 140, that equals to 1000 rupees, 1120. Is that correct? Let's check one more time. 300 plus 440 plus 240 plus 140 is equal to 1120. All right. Okay. Next, we have to find out the standard deviation. Okay, how do you find a standard deviation? So 0.3 into 1000 minus 1120, the expected return, to the power 2 plus 0.2 into 1100 minus 1120 to the power 2 plus oh wait, I made a mistake here. It is not 0.2, it is 0.4 probability. 0.4, all right. Here it is 0.2 into 1200 minus 1120 to the power 2 plus 0.1 into 1400 minus 1120 to the power 2. All right, and the whole thing to the power half. Basically, that is a square root. All right, so that equals to 1000 minus 1120, all right, into, okay, into 0.3. 4320 plus, so 0.4, sorry, that is 160, 1200 minus 1120 times 80, 6400 into 0.2, so that is 1280 plus 1400 minus 1120, 7840. Now add all this. So it is 13,600. Take the square root of that. And so standard deviation is 116.6. 116.6. All right. So we are done with the calculating. We are done calculating the expected return and standard deviation of A. Let's do the same thing for B. All right. So B. Again with 1,000 rupees, how many shares can you buy if the price per share is 100? So 10 shares. Okay, so 10 equity shares. Of Cox Limited can be bought for rupees 1,000. So let's show the probability distribution just like A. How we found out A? Show the economic condition, the overall return, and probability. Okay, so you have high growth, low growth, stagnation, and recession. All right, and what is the overall return? So 10 shares into 150, that is 1,500 rupees, 1,500. Then 10 into 130, that is 1,300. 10 times 90, that is 900. And 10 times 60, that is 600. Show the probability distribution: 0.3, 0.4, 0.2, and 0.1. Now let's find out the expected return. So the expected return is 0.3 into 1,500 plus 0.4 into 1,300, 0.2 into 900, and 0.1 into 600. So that equals to 450 plus 520 plus 180 plus 60 is equal to 1210. Okay, so 450 plus 520 plus 180 plus 60 is equal to 1210. Now find out the standard deviation. So standard deviation is what? Is 0.3 into 1,500 minus 1210 to the power 2, then 0.4, 1,300 minus 1210 to the power 2 plus 0.2 into 1,000 or into 900 minus 1210 to the power 2 plus 0.1, 600 minus 1 210. The whole thing to the power half. That's the square root. All right. Now find out how much is this. This will be, okay, 25,230 plus 3240 plus 19,220 plus 37,210 to the power half. So we add all this, it'll come to 84,900, where the standard deviation is 291.4. So we are done with B. All right. And finally C. Now C is different from A and B. Now in C, we have to calculate the expected return standard deviation of 500 rupees each in the equity stock of B Limited and C Limited. All right. So with 500, how many shares can you buy? Of course. So you can buy 5 shares of Box Limited and 5 shares of Cox Limited can be bought. All right. You can buy with 500. You can buy 5 shares of B Limited. 500. You can buy 5 shares of Cox Limited, C Limited. Again, show the economic condition. So you have high growth. I'll just write HG, low growth, then stagnation and recession. And the overall return probability, overall return is, so 5, all right, times 5 times, how do you, so 5 times 100, 5 times 100, all right, plus 5 times 150 is equal to 1250. So 5 times into 110 plus 5 into 130, 1200. 5 into 120 plus 5 into 90 is 1050. 5 into 140 plus 5 into 60, that is 1000. Of course, show your probability 0.3, 0.4, 0.2 and 0.1. Show the expected return. All right. So the expected return is 0.3 into 0.3 into 1250 plus 0.4 into 200 and 0.2 into 1050 plus 0.1 into 1000. So that equals to, the whole thing is 375 plus 480 plus 210 plus 100 equal to 1165. And then show the standard deviation. Now again, just like A and B, same thing. You take the standard deviation, the same way you find out standard deviation, and the standard deviation here will be 89.6. Please do that on your own. Check and see whether you get 89.6 or not. All right. So that is how you find out. You find out the expected return and standard deviation for a problem where you have investment in a single security and investment in a portfolio. All right. Thank you.